Hello and welcome to Property Matters. Today we're going to be looking at pensions and property. Joining me today is James Hadley, founder of Property from Pensions, tax specialist in the property market. And James, welcome to you.
Greetings, Steve.
So we're going to start off, and this is something that comes up on our question time quite a lot. Tell us about the common misconceptions about property and pensions. I suppose the primary one is that you can't have property in a pension, but you can.
Yeah, I mean, there are numerous misconceptions. You've got more general ones, like, I mean, how much can you put into a pension and over what period, and how much can you grow a pension fund over its lifetime, down to really more specific ones about what specific asset classes or types of investment can be made, what are the restrictions around those, and whether there are limits on the amounts that you can make.
Okay, so if one let's look at the types of property that you can put in a pension fund. We know you can't put residential property in as such, can you?
Well, you can. I suppose explaining that might be helpful. So if you look at the law on the taxation of pensions as it stands, if you've got a investment regulated pension scheme, which in plain English is either a self-invested personal pension or a small self-administered scheme, a SIP or a SAS. If you have one of those two things and that pension scheme invests into commercial property directly, i.e. it owns it itself, that's absolutely fine. There are no tax charges. It's a perfectly compliant investment. However, if you were to take the same pot of money in to buy, let's say it was a 2-bed terraced house, you'd suffer what's called an unauthorised payment charge, effectively a 55% tax charge on the amount you've invested into that residential property. So you are actually allowed to do that. It's just that you'll get a pretty horrific tax charge if you do. And that's where the misconception comes that you can't invest into residential property.
But that's hugely penal, isn't it? 55%.
Massively. And it's there to discourage.
I was just going to say that's to say don't do it, isn't it?
Yeah, absolutely. So, the tax relief that's been given maybe at a top level of 40 or 45 is being clawed back at 55%. So it's kind of insane to do that. But there's a specific section of the legislation that deals with exemptions to that tax charge where a pension fund owns property. And providing that a pension fund complies with one of those stated exemptions, you can avoid doing an authorised payment charge. So it's not a blanket, you can't invest into residential property. You just need to do that through a vehicle that has an exemption.
Okay. So just taking a look at that, if you invested, let's say in a commercial property, and there are limits to the amount that you can put into a pension pot.
Yeah.
What is it that's calculated? Is it a constant reviewing of the value of that commercial property in the fund, or is it gauged by the amount of income it produces, or how's that calculated?
Okay, so contributions, the amount that you can put into a pension scheme, is limited on an annual basis. And there are differing figures depending on whether it's an employee contribution or employer contribution. And another one of the misconceptions actually is that pension funds are capped at being able to grow to 1.073 million. And that's not actually the case. It's just the case that if someone grows their pension fund to a number that's higher than that and then takes benefits from it, we have what's called a benefit crystallisation event. At that point, the whole value of the pension fund is assessed against that a lifetime limit. And anything over that is taxed, again, with a recovery charge of 55% on lump sums.
I see. So you really need professional advice on this all the way through, don't you?
To a degree, yeah. I mean, there are some people that are taking control of their finances and specifically their pension funds. And I think that's a really responsible thing to do, because historically people had to be forced into saving, I think, culturally in this country. But there are I suppose there were two legs to it, is that doing it yourself, you could get things wrong, and that's a disaster, and we don't want that to happen. But on the more positive side of things, there's probably a whole load more opportunities that could be exploited if someone was advised, whether if they tried to do it themselves,
right.
Because people just cannot understand it all like a professional would.
Okay, well, we've just talked about putting your pot of money into property via a pension. What happens if we kind of do it the other way round? What about utilising your pension to get some property?
Yeah. Well, I mean, that's a fairly common route now. With property being the way it is, though, in terms of entry points and pricing, people do tend to need a fairly substantial pension fund to be able to get into that in the first place. Yes, we've had incidences where people have been absolutely hell-bent on investing into property, and they've gone along and bought themselves a lock-up garage in South Wales for £8,000, and that's fine, but they've also found themselves that the running costs of that pension scheme holding that one small property far outweigh the returns that they get on it.
Okay, and when you're coming to utilising your pension for property investment, are there any sort of extra risks there that you're taking over and above making a normal property investment in normal sort of working sphere of life?
Well, I think that there are, because of course, depending on the age that you do it, you might put the money in and you might make the property investment, but then you might struggle to get any money back out, because if you can't take any benefits from the pension scheme until you're age 55, imagine if you had some sort of liquidity crisis in your life age 52, and you've got this really well-funded pension that's about as much use as a chocolate teapot, because you can't
touch it.
Yeah, absolutely.
Okay. So that's the major risk, isn't it? And then, of course, I suppose you get, if you're paying cash into a pension fund directly, you're getting tax relief on what you're paying in. If it goes to property, is that still the case or not?
Well, if you look at it as two steps, if someone makes a contribution to a pension scheme, they will get tax relief, whether that's an individual making a contribution or an employer.
Right.
Once the pension scheme then makes its investment into property, of course, that property belongs to the pension scheme, and that means any rent that's derived from that property belongs to the pension scheme.
Okay. And is there a limit? Let's say you invest wisely, you've invested in a good commercial property, rents are going up, hopefully, all the time. That rental income goes into the pension pot. Does that preclude you from putting anything else in over the coming years, or is that calculated into your contributions?
No, and that's an interesting distinction to draw, and one I just answered yesterday. So the rental income that the scheme receives, it doesn't count towards any sort of annual allowance that you might have on contributions going in.
Okay, so actually you can sort of hit the double whammy there, can't you, and have quite a good...
Absolutely, and it's great for business owners, and this is something I've done myself. I have a small self-administered scheme. It owns property, and some of that I rent. And so I've got the ability to put up to £40,000 a year into my pension scheme as a contribution, but of course there's the rent from my trading business going in as well that doesn't count towards that annual contribution allowance.
No. But of course, your rental expense is presumably tax deductible.
Still tax deductible, absolutely.
Yeah. So triple whammy.
Yeah.
Well, that sounds very good. Now, in terms of buying your commercial property, I think we'll stick with that because it's simpler, isn't it? In terms of buying your commercial property for the pension fund, obviously you've got some money to go in from your pension pot. Now that might relate to the deposit. Can you borrow the rest, or what are the consequences of borrowing the rest?
Yeah, there is a market out there for lending to pension schemes. I mean, pension schemes are ultimately trusts, and so while the market for lending to trusts is more limited than to, say, individuals or limited companies, there are still lenders out there that have got appetite for it. A pension scheme itself can only borrow 50% of its net asset value. So let's say you'd got a pension scheme that was valued, and for the sake of argument, you've got £200,000 in cash. Ignoring all fees, you could borrow £100,000 and buy a £300,000 property.
Okay. Even though the full value of that 300,000 goes into the pension fund, you still got that limit.
Yeah, so essentially there's £200,000 of pension fund, there's £100,000 of borrowing, that buys £300,000 worth of property.
And that's the asset.
Yeah,
Got it. Okay, that balances out fairly well, doesn't it? Now, in terms of you've mentioned sort of self-administered schemes, small self-administered schemes, I think they're called, aren't they?
Absolutely.
And then there's the larger sort of scheme, which is probably run by an institution. So have I got that right?
Yeah.
Yeah. Okay. Just talk about the benefits or pros and cons of those two sort of vehicles, if you like.
Okay, so I guess the major and obvious advantages of pension schemes per se is that you get tax relief on the way in, so you get assistance from the government to grow it from day one. You get income tax-free returns, whether that's on rental income or dividends received on shares into the scheme. If you sell any of those assets at a profit, you've got capital gains tax isn't applicable. And those assets don't sit in your estate for inheritance tax purposes, so there's no inheritance tax on there.
Nice.
They're basically the most tax-efficient vehicle that we've got in the UK. But one of the often overlooked benefits to business owners is creditor protection. Because, of course, for people that are building a business and in their mind they've got an eye on an exit, I'm sure most people start a business and think, okay, at some point in the future we'll sell it and sail off into the sunset. What about if that doesn't happen? There's lots of things that could get in the way. People's health could fail, an insolvency event, or litigation, all sorts of other things that could prevent that from happening. But if people have been putting money into pensions over the years, company directors have been putting money into pensions, providing they've not been doing that to deliberately deprive any creditors of repayment, those monies are ring fenced from insolvency. And so what's being created is a hedge against insolvency and against
ring fenced against the vagrancies of life, I suppose.
Yeah, so it's not just creditor protection, you've got tax protection as well.
Okay. All right, James, thank you for that. We're going to go to a break now, and after the break I'll be talking to James about some of the different types of vehicles that you can use for your investment. Hello and welcome back to Property Matters. I'm Stephen Galpin and I'm talking to James Hadley, founder of Property from Pensions. So, James, we've talked about some of the opportunities of putting money into a property-related pension fund, if I can phrase it that way. Talk to us about some of the vehicles that can be used. And I think specifically you've got your GDCV opportunity. Let's start with that one.
Okay, I mean, GDCVs, they're a real mouthful, bit of a tongue twister, but it's a term that HMRC use in their own pensions tax manual to describe vehicles through which a pension scheme can invest into residential property without there being horrific tax charges.
Does that include the 55?
Yeah, absolutely.
Right,
55% an authorised payment charge. So a GDCV is a way of investing into residential property without that, ultimately.
Okay. Right, and it's as simple as that. It has to be an approved scheme, does it, that they validate?
There are, I mean, there's the legislation itself, Schedule 29A of the Finance Act 2004, and then you've got the HMRC guidance. But what's really great about it is that the two agree. So HMRC's interpretation of the legislation is pretty much how we see it as well. And so by following the guidance in that particular in that particular piece of legislation, you can get to a point where the outcome is that a pension scheme invests into residential property.
Okay, and typically what would those schemes be?
Okay, they can take different forms. So the three types that are outlined in the legislation, you've got trading concerns. Now, a trading concern would be essentially, imagine probably a listed house builder is a great example. So if you think of a listed house builder, we won't name any, but at any one time they're going to have thousands of properties in their balance sheet as stock. They're also potentially going to have part exchange properties in there. And it would be nonsensical really for pension schemes to be levied with an unauthorised payment charge when there's so much pension money in the FTSE 100 through trackers anyway. So there's an exemption for trading concerns.
Okay.
The next big one is real estate investment trusts.
That's a real...
Yeah, absolutely. Yeah. And so again, there are multiple real estate investment trusts in the FTSE 100, and it would be nonsensical for FTSE 100 trackers to be dragged into that.
Okay. Now, with these REITs, do they have to be approved by anybody? Do Revenue have to say yes, that's an authorised scheme? Or
there are specific conditions that a company has to meet to be a part of the REIT regime. And then if you fall into that category and you elect to become part of the regime, there's an exemption from paying corporation tax on the rental profits of the company.
Right, but how would that not be the case with a REIT? Would it because it's small or because it's self-administered? Or
I guess there's two aspects to that. There's complying with the regime itself and entering the regime, and then there's the requirements of a pension scheme investing into the REIT, and those two things aren't directly compatible. So there are additional requirements on a real estate investment trust from a pension perspective investing into it than would be imposed on a company just entering the REIT regime on a standalone basis.
So who would handle the? I mean, that to me, I'm totally simple as far as these things are concerned. It's really a bit above my head, but who would administer that? Who would help you set it up? Who would then administer it for you?
Well, essentially, it's the company's responsibility to enter into and to comply with the regime. So you need to have good tax advisors, you need to have good lawyers, you need to have good accountancy support, and so on and so forth. And fundamentally, you need to be able to run a good business, because that's ultimately what they are. So there's no point in setting up a real estate investment trust and getting yourself effectively to the start line if you don't know where to source your properties. You've got no one to manage them. You don't know how to raise the finance or where to get them from. So there are all sorts of commercial things that need to be considered first and foremost before the tax implications of entering the regime.
Okay, so just going back to something I think we were talking actually off camera about.
Sure.
Let's go back to this sort of theory that in effect it's certainly a lot easier, a lot more practical to invest in commercial property for your pension. Let's say, for instance, you go, righto, what I'm going to do, I'm going to build a block of flats, but they are going to be for social housing, and I'm going to let the block simply to a social housing operator, if you like. Would that conform to the requirements of an acceptable pension scheme?
Absolutely. I mean, you would structure it in the right way. So you could have the pension scheme investing into a REIT, and the REIT rents those properties to a social housing provider, and so that would tick the box. You could also set up another type of GDCV, a property unit trust, and similarly, you could have a property unit trust owning those properties and renting them to a social housing provider. Yeah.
What I'm trying to get to and assess is that as you get later in life and your pension becomes a more critical part of your income, I'm just trying to assess how much work there is to do in operating these schemes, because I think that is a consideration. Your health may not be as it was 20 years ago or whatever. Your energy levels might well be down. And on top of that, I would guess, correct me if I'm wrong, but I would guess it's important too to assess the professional fees and general running costs of these things. I mean, if you use, for instance, a big firm of accountants, you know what it's like. Every letter that's written's £50 or £100 or more, and it all adds up.
Yeah,
and it all comes off the top line, doesn't it?
Yeah, I guess so, and I think that's been the barrier to entry for a lot of people to setting these sorts of GDCV vehicles up, because historically the cost of doing so could run into the six figures quite easily, and more if you're not careful which law firm you choose. But billing 6-minute increments and hundreds of pounds an hour.
And they do,
and that's their business model. So people go into that with their eyes open. But I think that where people have a critical mass of pension scheme and they want to supplement that with some borrowing as well. So let's say they've got 6 figures in the pension fund and they want to borrow on top of that to a decent loan to value, that can offset the cost of the professional fees, which typically, I mean, being someone who spends hundreds of thousands a year on legal fees for running the business anyway, I'd always suggest that anyone entering into a relationship with any professional should always ask for a fixed fee quote, if possible. I mean, the solicitor, accountant, tax advisor, whoever could turn around and say, I'm not going to do that on a fixed fee, because that would be effectively writing a blank check, and that's fine. But in all cases, a fixed fee would be advisable.
Yeah. Okay. I mean, these professional fees are a difficult thing. And we were talking again off camera about being very careful about how you take your advice. I mean, I've found over the years, when asking a solicitor, for instance, over advice, and accountants a little bit the same, you've got to be very clear about the question you're asking, because you won't get an all-encompassing answer which takes into consideration that, and that. You'll get a direct answer to the direct question you've given, and that's all you'll get.
Quite exactly. I think it's all in the instructions that you give, really. That's where ultimately that will dictate the outcome. And I think sometimes that's where being properly advised will lead to a better outcome, because you actually know the questions to ask, know the instructions to give, and it also reflects back into the cost as well. If you don't have to go all around the houses examining a load of issues that aren't relevant to the task in hand.
Sure. But James, just to sort of get towards the end of this, what I'd like to understand from you is at what point you would start the process of this. In general, would it be advisable for a young person starting off with a pension scheme to get involved in this sort of thing? Or is it the sort of thing you get involved in halfway through your working life and you're saying, right, I am now looking towards retirement, I'm looking towards my later life income? At what point would you really say this sort of thing becomes critical?
Well, I think it's when a pension saver has hit a critical mass in their pension fund, because there are additional costs to buying and holding directly held property or through using a GDCV. The pension fund has got to be able to cover those costs and still make a profit. So, for example, we get people coming to us all the time and say, hey, can you set us up a small self-administered scheme? We want to invest in property. We've got £25,000 in a pension scheme. And I love that enthusiasm. You know, it's great that people have got a goal and they can tell us what they want to do. But if you've got to pay, £2,000 to set up a small self-administered scheme, and then you've got transactional costs of buying the property from both the trustee's side and the law firm, SDLT and other things, you could be quite easily, and that's before the cost of advice, you could quite easily be at £5,000 before you've even got going.
Yes.
Well, that's 20% of the pension fund.
Yeah.
And then if you're paying £2,000 a year to run it, you're into 10% per annum. So you've got to get a very, very high return on capital to make the thing worthwhile. Sure. So I do see these things as being, if you think of pensions as a journey from when you start saving to the point where you're taking benefits, they're definitely in the mid-ground. Right. They're probably when people they're into six figures in their pension scheme or capable of contributing to that. Okay.
And just finally, the initial approach to get advice on this. Now look, I introduced you as founder of Property from Pensions.
Yeah.
Just tell me and the viewers, exactly what is that? Is that a firm of accountants? Is it a firm of tax advisors? Is it a firm of sort of brokers in one way? What's your constitution?
We're a tax advisory practice, and we focus solely on the nexus between property and pensions.
Okay.
So that's all we do.
So you'd be an absolutely ideal place to start.
Yeah, but the one thing we don't do, and it's important to be clear, we don't give investment advice. If someone were to come along and say, is investing in hotels in Whitby better than investing in HMOs in Nottingham, I'm not your guy.
No.
Asking me who the best lender for serviced accommodation is, that's not my thing. No. Naturally, we've got a wide professional network that deals with all that sort of stuff, but we stick to the knitting. It's complex tax problems.
Okay, James Hadley, thank you very much for your wisdom. I'm sure our viewers will be most appreciative.
Thanks, Stephen.
I'm Stephen Galpin. This has been Property Matters. Look forward to seeing you next time.